Offset versus redraw, the difference that only matters when you need your money. Offset and redraw looks almost identical from the outside. Both let you park extra money against your home loan, both save you the same amount of interest, and both feels like smart move. But the moment you need to pull that money back out, they behave in completely different ways. And one of them can quietly cost you thousands in lost tax deductions. Here is how the two actually works and why the difference matters more than most people realize. Say you are about to buy a new home and rent out the one you are in now. The extra money you have been putting aside has been going into your loan's redraw facility. Redraw is not a separate account, it's a feature built in the loan itself. And every extra dollar you pay in reduces the balance your bank charges interest on. So you have genuinely been saving on the interest the whole time. But the money never actually left the loan. It is still sitting inside it. You're reducing what you owe. To get any of it back, you have to ask your bank for it. And while some banks give it to you straight away, others take a day or two. The moment you pull that money out, it becomes a fresh part of your loan again, and that is about to matter a lot. Now picture the same savings in the same time frame, but sitting in an offset account instead. An offset account is a separate account linked to your loan, and it works like any other bank account. So you can spend from it, transfer from it, or use a card on it anytime you like. The way it saves you money, it's different too. Your bank charges you interest on your loan balance minus whatever is sitting in your offset, which means the money has been quietly reducing your interest the whole time without ever becoming part of a loan. This is real difference between the two. Redraw money is a loan money you have prepaid, while offset money is your money sitting beside the loan, never merging with it. Both paths have saved you the same amount so far, but the moment you need to use that money, they split in very different directions. You have found a new place. You need that extra money to help make it happen, and your old home is about to become rental. Just as an example, let's say that money has grown to $100,000. If that money is an offset, this part stays simple because you transfer it out the same way you would move your money anywhere else, and nothing about your loan changes. Your investment loan stays fully tied to a newly converted investment property and fully deductible. If that money is in redraw, it plays out very differently because to use it, you have to redraw it, and the ATO does not see the withdrawal as getting your own savings back. It sees it as a brand new borrowing. So it asks one simple question: what that money was actually used for. You used it towards your new home, and that makes it personal purpose rather than an investment one, which means the interest on that portion is no longer tax deductible, even though it is still sitting inside the loan attached to the property you now rent out. Sticking to the same example, redrawing 100,000 means the portion stopped being deductible from that point on, and left alone for years, it can quietly add up to tens of thousands of dollars in lost tax deductions. You might think you could simply pay the money straight back into the loan and undo it, but you cannot. The ATO looks what the money was used for at the moment you drew it out, not whether you topped up the loan back up afterwards. So once it has gone towards something personal, it stays classified that way, even if you repay it at very next day. So now your one loan is really two loans wearing the same account number, with the part of it staying deductible and part of it no longer qualifying. Sorting that out at tax time is real headache, and some people end up needing to split the loan or refinance it just to separate the two. The same saving, built the same way over the same time period, can send you down two completely different paths, depending where that money was sitting when you needed it. In offset, moving it cost you nothing. while in redraw, moving it can quietly cost you a great deal over the life of the loan. That does not mean redraw is a bad option. If you are confident you will never turn this property into rental and you know you will not touch that extra money, redraw still works fine, and on many loans it comes with no extra fees. But if there is any chance you will buy again and rent this place out, offset is what keeps your finances easy to separate later and keeps your deductions safe when it matters most. A lot of people end up using both: offset for the money they might need to move and redraw for the money they are confident they will not touch. What matters is knowing which one your money is actually sitting in before you are the one standing at the bank making that withdrawal. One withdrawal is all it takes to turn a clean investment loan into a tangled one. So before you withdraw a large sum for any reason, stop and ask what that money is about to fund, because that single question can be the difference between a simple transfer and a tax problem that follows you for years. Everyone's loan and tax situation is different, so treat this as a starting point and check your own situation with your accountant or lender before you act. If you're not sure which one your loan even has, that's a 5-minute check with your bank. Do it before your next big purchase. And if this saved you from a mistake, subscribe. We break down topics like these every week. Thank you for listening.